Now the market right now feels like a little bit of a roller coaster. One minute we're looking at all-time record highs and excitement around AI and tech, and then the next minute it completely flips. People are talking about this AI bubble bursting, a recession, and possibly the worst market crash we've ever seen. And it leaves you wondering, what is happening behind all of this noise? With this, you've likely noticed that the market doesn't necessarily move based on logic, numbers, or company fundamentals. A lot of the time, it's being moved by emotion. Fear, excitement, panic, and greed. This reminds me of one of Warren Buffett's most famous quotes. Be fearful when others are greedy, and be greedy when others are fearful. The idea behind that quote is that if you can gain a good understanding of the market sentiment, this will give you a massive advantage when it comes to investing. So today, we're going to look at something called the Fear and Greed Index. It's a tool specifically designed to understand if people are acting out of fear, or out of greed, or somewhere in the middle. Within this video, we'll cover what the Fear and Greed Index actually is, how it works and how it's calculated, how it's lined up with stock market movements in the past. Most importantly, we're going to look at how you can use it to make smarter investing decisions. Okay, so let's start with the basics. What actually is the Fear and Greed Index? Well, the Fear and Greed Index is a tool designed to measure the emotional state of the stock market. We're talking fear, greed, caution, excitement, and turns all of this into a single score from 0 to 100. Now 0 means extreme fear and 100 means extreme greed. And anywhere in between will tell you that general mood of the market. You can see as of today that it's currently indicating that the market is leaning towards fear, but more on that later. This index was originally created by CNN Money. It was developed in the early 2010s and released in 2012 after the dust of the 2008 financial crisis had settled. During this crisis, investors were panicking, markets were crashing, and emotions were running the show. The team behind this wanted a way to help the everyday investor understand what was driving the market emotionally and not just financially. So they built something broader, and they built this using 7 different barometers. First was stock price momentum. This looks at how the S&P 500 is performing compared to its 125-day moving average. If prices were far above the average, it signals confidence or greed. If they're below, fear is dominating. Think of it as a way to see if the market's on a hot streak or slipping. Momentum often tells us how emotional investors are, rather than just what the fundamentals say. Next is the stock price strength. Now this measures how many stocks are hitting new highs versus new lows. More highs generally means more optimism and greed, and more lows equals fear. It's a good way to check whether the market rally is broad-based or if only a few big stocks are driving it. Then we have the market breadth, so how many stocks are actually participating in this rally. High volume in rising stocks shows confidence, and high volume in falling stocks shows fear. Even if the index looks positive, if the rally is narrow, it might not be as strong as it seems. Number 4 is the put and call options ratio. This shows whether investors are buying protective puts, which signal fear, or speculative calls, which signals greed. In case you're not familiar, a call option is basically a bet that a stock will go up. You pay a small amount now for the right to buy a stock at a certain price later. And a put option is the complete opposite. It's a bet that the stock price will go down. It gives you the right to sell at a set price, protecting against a drop. So when this put-call ratio is high, it means a lot of people are buying protection against falling prices, which is a sign of fear. Low ratios mean that people are mostly buying calls, betting on gains, which is a sign of greed. Next up, we have the market volatility, which is measured by the VIX, also known as the fear gauge. A high VIX equals fear and uncertainty, and a low VIX is calm or overconfidence. It's one of the most widely watched indicators for gauging panic or risk appetite. Number 6, we have the safe haven demand. This compares how much money is flowing into safer assets such as treasury bonds versus stocks. Heavy bond buying equals fear, and low bond buying equals confidence or greed. It shows us where investors are seeking safety, sometimes even before stock prices react. And finally, we look at something called the junk bond demand. Appetite for high yield, riskier corporate debt. High demand in this area equals risk-taking and greed, and low demand here would show us that there's caution and fear. Now, investors buying riskier bonds are showing that they've got confidence in the economy, and extreme greed here can be a warning sign that people are chasing yield without any caution. So now you understand what this index is made up of. It's time to have a little look to see if it compares to real-world events. So here's a real example from earlier this year. If we look at the S&P 500 in mid-February, The market was still climbing and most headlines were optimistic. It didn't look like a huge risk on the surface. But if we put this against the Fear and Greed Index, something interesting shows up. The index was reading fear just before the market began to decline. So what does this mean? Essentially, even though prices were high or stable, investor sentiment was already cautious. People were buying protective puts, safe haven demand was creeping up, and the overall emotional tone of the market was more fearful than greedy. If you were watching this index at the time, this might have been a signal to potentially rebalance your portfolio or hold off on more riskier investments. Now the point of this is that the Fear and Greed Index won't tell you exactly when the market's about to change, but it does show when the market is showing extreme fear or greed. And historically, extreme readings have normally followed with quite big moves within the market. In this case, the index was already signalling caution before the drop. Now to really show how powerful this information could be, I'm going to share an example from Chris Davis. His example focuses on 3 different investors, and all 3 investors invested $10,000 at the exact same time. They did it at the worst possible moment, right at the peak of the market in 2007, just before the financial crisis. But what happened next depended entirely on how each investor reacted. Investor A panicked as soon as the market started crashing. They sold their investments during a downturn, locking in their losses. The result? They ended up with the lowest returns by a huge margin. They bought high and sold low, and emotionally missed the recovery. This is the trap that most investors fall into during fear. Investor B, however, took a different approach. They didn't react emotionally. They stayed invested through the entire crash and the years that followed. They recovered fully and ended up with solid long-term gains. Not spectacular, but steady, because they simply stayed invested and didn't let this fear push them out of the market. And then we have Investor C. They also stayed invested during the crash, but they went one step further. When fear was at its highest and the market was at its worst, they invested more money. Investor C added a further $10,000. They bought when everyone else was selling. They ended up with the highest returns by far, massively outperforming the other 2. Not because they timed the market, but because they acted when fear was dominating everyone else. So why does all this matter? Well, all 3 investors reacted completely differently. The difference wasn't timing or luck, it was behaviour. How they responded in periods of extreme fear determined their long-term investing result. This is exactly why tools such as the Fear and Greed Index can be so valuable. It'll show you when the rest of the crowd is making emotional decisions. And if you can take the opposite approach, this is when it ties back to that Warren Buffett quote, where you should be greedy when others are fearful, and the long-term results can be incredibly powerful. So to wrap up this topic, it's important to know that this index is not a magic button. It's not a timing tool, and it definitely shouldn't be the only tool you use to decide whether to buy or sell a stock. But what it is a genuinely useful tool to have in the toolkit. It helps you understand the emotional temperature of the market, and you should pair this with company fundamentals and also a long-term investing strategy. It'll help you avoid emotional decisions and also help identify opportunities within the market. If you're keen to check out the current market score, then I'll leave the link to this in the description. If you've enjoyed this video, then please do subscribe. If you'd like to see my own personal investments, this is also documented on the channel with complete transparency. Thanks for watching, and I'll see you in the next one.